Hello everyone, Hector here with the Investment Brothers, giving you education and inspiration for the fix and flip as well as wholesaling business. One of the most common questions that I get asked, especially by people that are new to the fix and flip business, is how does hard money work? And so I wanted to make this video to kind of give you a general overview of the way hard money works and some of the information that you definitely need to keep in mind when you're analyzing your deals, and to make sure that you understand your financing and the ins and outs of the financials of any deal that you're getting into using hard money. So hard money is basically a loan that is specific to properties that need a lot of repairs. It's a loan where most investors that are not dealing with cash, that are not buying properties cash, they usually get a hard money loan. And it's a loan that's, it's not the cheapest loan out there. It's not your typical conventional type of loan, but it has a lot of benefits, especially for people that are in the fix and flip business. The reason why is that hard money loans are basically loans where they don't focus on the borrower, but they focus on the deal itself. So that means that if you have bad credit, or you have foreclosures in the past, or maybe you're self-employed and you don't report a lot of income on your taxes, none of that really matters. The lender's really going to focus just on the deal itself. So if it's a good deal, if there's money to be made on it, they'll lend on it. And hard money loans are basically loans where they're typically 6 months to a year in duration. They have to be paid back, or you have to be either by selling the property or by refinancing. So they're short-term financing for this type of specific project, what is fix and flip investing. So in hard money, there are some key terms, some key elements that you always have to keep in mind in order for you to properly understand what you're getting yourself into. And one of the most important terms that you're going to hear often when people are talking about hard money financing is the term ARV, which stands for after repair value. ARV is the after repair value. It's basically what the lender believes that this property is worth after you do all of the repairs that you say that you're going to do on the property. And ARV really is one of the most important things that you need to learn to determine as accurately as possible, because for you as a borrower, ARV means what you are going to sell the property for. So between the lender's underwriting and your own due diligence, you're most likely both going to come up to the same level of determining an after repair value. In addition to that, there's the concept of points. Points is basically 1% or 100 basis points of the loan amount. That's 1 point. Most hard money lenders will charge you I've seen up to 5 points, 6 points on some loans, depending on the lender. But it's basically a percentage of the loan that you're going to pay as a fee. It's part of the cost of obtaining the financing on the deal. They're referred to as points. And it's something that you're going to have to, as a borrower, back out as an expense on the deal that you're getting. In addition to that, you're going to pay fees. You're going to pay underwriting fees, inspection fees, this fee, that fee. Just like any other type of financing, there's always fees that go along with it. That's how the hard money lender, in part, how the hard money lender makes their profit. So you're paying points and you're paying fees. In addition to that, you have the concept of construction holdback. One of the benefits of using hard money is that hard money loans, many times they will lend you 100% of the cost of the repairs of the property, in addition to the price that you're paying for the property itself. So most of the time, they'll lend you all of the money that you need to fix it up. They'll put it in an account known as a construction holdback account. So construction holdback is basically the money that the lender sets aside that you're going to draw on to do the necessary repairs, and they're going to give it to you in part. Most of the time, most hard money lenders will give it to you in phases. As you're progressing in the repairs of the property, they'll send out somebody to go and inspect, make sure that you've done the work that you said you were going to do, and they'll give you a portion of the money that is in the holdback account for you. As you repair it further, as you go further along into the remodeling process, they'll inspect it again, give you more money, so on and so forth. So that's typically how construction holdback works. And you have the concept or the term of payments. Okay, now payments on a hard money loan are different than a conventional type of loan. When you make a payment on a fixed rate, conventional 15-year, 30-year mortgage, every time you make a payment, in that payment is a portion that goes to the principal pay down, and there's another portion, which is usually the larger portion of the payment, that goes to interest. So you're paying both principal and interest when you're paying a traditional mortgage. When you take on a hard money loan, they are interest only payments, which means that every payment that you make is 100% interest only. That means that when you make a payment, none of it gets applied to the principal. It's all interest. That's another way that the hard money lender makes money. So again, they're short-term loans. The idea is that you borrow money, fix up the property, sell it or refinance it, and pay the whole thing back. So your payments are always going to be interest only. Now, one thing to keep in mind when you're dealing with hard money, and this is probably one of the most important things that you always need to remember, is that most hard money lenders are going to lend you up to 70% of the ARV value, of the after repair value. They're going to lend you 70% of that. Now, as you get more experience and you progress further in your fix and flip career and you get some deals under your belt, some lenders will give you a little bit more. They'll give you a higher percentage of the ARVs. I've seen some of them go up to as high as 85% of ARV for borrowers that have experience, that have a track record, that know what they're doing. If you're new and this is going to be your first deal, or you're barely getting started, most likely they'll lend you up to 70% ARV. Sometimes they might even go only as high as 65%. So just know that as you get more experience and as you find some more lenders that might be a little bit more aggressive in their lending standards, they might lend you more money. But in this example, we're going to use a 70% ARV, and we're going to talk about an example of a property that's going to be worth $500,000 once it's fixed up. Okay, so if we're talking about a deal that's worth $500,000, okay, they're going to give you 70% of the $500,000 ARV amount, which pencils out to $350,000. Okay, $350,000 is 70% of $500,000. Now, that $350,000 represents the maximum amount that the lender is willing to let you borrow. So let's say, for example, that you find a property that is, you're tying it up for $325,000. Okay, I'm going to give you an example of a property where you're going to have to come in with a little bit of money to make the deal work. Now, you're buying it for $325,000. Let's say that the property needs $50,000 in repairs. In addition to the $50,000 in repairs, you're going to probably, at that price point, you're probably going to end up paying somewhere around $10,000 between points and fees. So you add that into the formula here. So you're talking about $385,000. Your $325,000 purchase price, your $50,000 in construction, and your $10,000 for your points and your fees. Now, remember, they're only willing to lend you up to $350,000. So when you back that out, that means that you as a borrower need to come in with $35,000 in cash to make sure that you're able to fund the deal. $325,000 is the purchase price, $50,000 in repairs and $10,000 in points and fees is $385,000. They're only willing to lend you up to $350,000, which means that you have to come in with the difference. Now, this $35,000, you bring it in at the close of escrow, you bring it into escrow. In addition to the $35,000, remember, you're going to have to make interest-only payments for the duration of the loan, for however long you have the property before you sell it or refinance it. So typically, if you're in and out quick, you're in and out in 3 months. I would say most of the time, most rehabbers are in and out of their deals in 5 to 6 months. So in addition to the $35,000, $3,000 payment per month times 6 months is another $18,000 that you're going to have to pay throughout the 6 months. Every month you're going to be sending your payment. So once you add that into the formula here, you're looking at $53,000 in total money out of your pocket to make this particular deal work. Now, many times people ask me, hey, I've heard people say you can buy real estate with no money down. That you can do hard money deals and you can buy them no money out of your pocket. That is true if you get the deal cheap enough, okay? If you get a deep enough discount on the property, you are able to buy properties where it's so deeply discounted and there's such a huge margin of safety that the lender's willing to lend you the purchase price, the rehab costs, the points and the fees, and 6 months worth of interest if you get it at a good enough price. Let me show you what that looks like. Let's say, for example, you get another property, the same property, but you get it at a ridiculously good price, and you pay $250,000 for the same house, okay? Now we know it's going to require $50,000 worth of work, and you're going to have about $10,000 in points and fees. That puts you at $310,000 that you're into the deal. Now remember, the lender's willing to lend you up to $350,000, 70% of $500,000. So you're only at $310,000, so you're well below that 70% threshold. Now you may say, well, that means I have room on the deal. Will they lend me the payments so that way I don't have to make any payments during the time that I own the house? And the answer to that is yes. Again, $3,000 payment at 6 months is another $18,000. So that puts you at $328,000. Still well below the $350,000 threshold. Now that still gives you room to include your title and your escrow and whatever other fees you may have. Or you may even want to ask for a little bit more rehab money, because you never know. Sometimes you go over budget, unfortunately, or things come up. You know, there's always repairs that may be unforeseen. So you have another $22,000 of wiggle room in this particular scenario, where you can ask the lender for more money and still be no money out of pocket. So this is how you're able to buy a piece of real estate, buy it, fix it, and sell it, and not put any of your own money into the deal. You have to get it at a deep enough discount where you can include everything that you're going to have to pay in that particular deal in the loan amount. So we've got two examples here. Both are money-making scenarios. It's just that one, you have to come out of pocket with the $35,000 plus the payments you're going to make every month. And this one, you're getting it at such a good discount that you don't have to put anything out of your pocket. That's basically the way hard money works. It's financing where you don't have to jump through the hoops of a traditional lender, where they're going to look at your taxes, they're going to look at your reserves, they're going to look at the condition of the property. Do you have good credit? Do you have 2 years of stable income? What's your debt to income ratio? None of that factors in when you're dealing hard money. Hard money lender is more expensive, but the benefit to that is they're quick cash. I mean, most of the time you can fund the deal in 10 to 15 days once you have a track record with a particular lender. They're short-term duration, they're interest only. It's expensive money, you know, let's be honest, it's expensive money. However, you can still make a good profit using hard money lending. And as you can see, if you can get a deal at a deep enough discount, not only are you able to make a good profit, but you're actually able to do it without putting any money out of your own pocket. So that's the way hard money works. Remember, once you get the hang of things, these numbers, such as these terms and these numbers, ARV, points, fees, construction, holdback, you're going to know it backwards and forwards, where you're going to be able to do the analysis on a deal in your head. And literally in a few minutes, you're going to know if there's something there or if there isn't in terms of profit potential. So always keep this in mind, guys. Remember, know what you're getting yourself into. Understand the terms of hard money. Understand what hard money is compared to everything else. Know well what you're going to be paying out of pocket, and run the numbers. Run a couple different scenarios. Look, if you have the money and you might be willing to put up more money, if it's not a burden for you, you can definitely lower your financing costs that way if you put more of your money out of the deal. But if you're looking to maximize your leverage and maximize the return on the money that you put into the deal, if any, then hard money and trying to get as much leverage as you possibly can is definitely the way to go.